Okay, welcome back to the deep dive. Today, we are jumping into something that's, well, on everyone's mind if you're in or even near the digital asset space, cryptocurrency regulation.
Yeah, absolutely. It's everywhere.
And you've handed us a stack of sources, articles, research papers, expert takes that paint a fascinating, pretty complex picture of how the world is trying to get a handle on Bitcoin, Ethereum, and, everything in between.
It's truly a global puzzle. I mean, the material shows just such different approaches, from outright bans to attempts at creating really clear, comprehensive rule books. It's anything but simple.
Absolutely. And our mission in this deep dive is really to unpack these sources for you, pull out the most crucial insights. We want to understand why this is so difficult, see the wildly different paths countries are taking, and sort of figure out what it all means for the future of digital money.
Let's get into it.
So let's start with the fundamental challenge. Why is regulating crypto such a headache, in the first place?
My sources kept pointing back to one core issue. This technology, it just doesn't fit neatly into the traditional legal and financial boxes governments have used for decades, maybe centuries.
That's really the heart of it. One expert quoted in the material described Bitcoin as a legal platypus. I mean, that's a perfect way to put it, right?
The platypus, yeah.
It has elements of currency, maybe property, technology, but isn't quite any one thing cleanly.
A legal platypus. I love that. And you see that confusion playing out vividly within single countries. Like, look at the U.S., for example. The IRS, the tax folks, they look at Bitcoin and say, okay, for tax purposes, that's property.
Right, meaning you owe capital gains tax when you sell it if it's gone up in value, just like a stock or real estate.
Uh-huh.
But then the CFTC, the Commodity Futures Trading Commission, comes along and says, nope, we see that as a commodity, like oil or wheat. So yeah, depending on which regulatory body you're talking to and what you're doing with it, it can be treated totally differently, all within the same country.
And it gets even more granular than that. The sources highlight how different U.S. states have kind of taken their own initiatives, while the federal approach often involves trying to, well, interpret existing laws.
Right, like New York has its specific BIT license for crypto businesses, which requires pretty significant compliance efforts.
Yeah, a big hurdle for some. And then Arizona has even passed legislation recognizing smart contracts legally.
While federally, as the sources note, agencies are often trying to apply these old laws, like securities law or money transmission rules that were just never designed with decentralized digital assets in mind.
Exactly. It's like using, I don't know, a wrench designed for bolts to tighten a screw. It doesn't quite fit.
Yeah.
And it's not just Bitcoin, right? The sources discuss the many different types of tokens out there. You've got transactional ones meant for payments, utility tokens that give you access to a service or platform.
Security tokens that might function like owning a share in a company, or governance tokens that let you vote on how a blockchain project evolves. So many types.
And the problem for regulators, as the material makes clear, is figuring out which bucket any new token falls into, because the rules can be vastly different depending on that classification.
Yeah, and we saw companies try to claim their tokens were just utility tokens to sort of sidestep stricter security regulations, right?
Oh, absolutely. And the sources show regulators are pushing back hard against that, looking
Yeah.
past the label to the actual function and the, economic reality of the token.
Makes sense.
So this whole borderless decentralized nature isn't just tech jargon. It's a fundamental hurdle for policymakers who are used to regulating entities tied to physical locations and clear structures.
Okay, so we understand why it's tricky. A legal platypus, hard to box in. But where did this whole regulatory dance even start? Did the sources trace its evolution from something niche to something governments, well, couldn't ignore anymore?
Absolutely. Yeah, the material lays it out. In the very early days, let's say, 2008 to around 2013, Bitcoin was really seen as a small, maybe revolutionary, but niche tech curiosity. It was largely off the regulatory radar.
More like a fascinating experiment than a financial system at that point?
Exactly. But one early sign the sources point to is FinCEN's guidance in the U.S. back in 2013. FinCEN, that's the Financial Crimes Enforcement Network.
Right, the anti-money laundering folks.
Yeah, they basically said that if you're running a crypto exchange or handling funds for others, you have to follow the same anti-money laundering, AML, and Know Your Customer, KYC, rules as banks, verifying who your users are to prevent illicit activity.
That was a pretty early marker then.
It was a pivotal moment, yeah. And it was spurred partly by concerns about Bitcoin's unfortunate early association with the dark web market Silk Road. That definitely brought unwanted scrutiny related to illegal uses.
Right, that put it on the map in a bad way for some regulators.
Then from maybe 2014 to 2017, we saw adoption really start to pick up. And it wasn't just Bitcoin anymore. You had altcoins like Ethereum, Ripple, Litecoin starting to gain traction.
Okay, so the market was broadening out.
Definitely. This expanded the market significantly, and, well, governments had to start paying closer attention.
And here's where it gets really interesting looking at Japan. The sources highlight Japan making a, frankly, bold move in 2017, recognizing Bitcoin not just as an asset, but as legal tender under their Payment Services Act.
Wow, legal tender, that's huge.
It was a major step, and they followed up by establishing actual regulations for exchanges, requiring them to register and comply with strict AML KYC rules.
And the sources note that having one primary regulator, the FSA, Financial Services Agency, oversee this process really helped create clarity early on, made it easier to navigate.
Yeah, unlike the multi-agency approach you see in places like the US, which can be confusing.
Right. Another huge event in this period, 2017 as the sources detail, was the ICO boom initial coin offerings.
Oh yeah, I remember that. It was like crowdfunding on steroids for blockchain projects, right? They issued new tokens to raise money.
Exactly. It exploded. But the sources are really clear. With very little regulation, it became ripe for scams and, frankly, left investors exposed to huge losses.
It's a bit of a Wild West situation.
Totally. And that triggered a strong response, particularly from the US SEC, the Securities and Exchange Commission. They started classifying many of these ICO tokens as securities.
Ah, bringing them under existing financial rules.
Precisely. And they launched enforcement actions against unregistered offerings, signaling the regulatory environment was definitely hardening.
Okay, so the party was kind of over for easy ICOs by then. What happened next? The sources mentioned the 2018 crash.
Yeah, the next phase, maybe 2018 to 2020, included a big crypto market crash of 2018. The sources framed this crash, where Bitcoin lost a massive amount of value, as a real wake-up call.
For regulators and investors alike, I imagine.
Absolutely. It reinforced the urgent need for better investor protection and stricter standards across the industry.
So what came out of that?
Well, what's fascinating here is the global push that followed for more widespread AML KYC rules for crypto businesses, like really pushing them harder.
Okay.
The EU's fifth anti-money laundering directive, AMLD5, in 2020 is noted as a key example. It explicitly extended those obligations to exchanges and even wallet providers.
So, closing loopholes. And what about taxes? Governments always want their cut.
You bet. Governments started getting serious about getting their share taxation. The U.S. IRS had already classified crypto as property way back in 2014, but they issued much clearer reporting guidance in 2019.
Making it harder to ignore, basically.
Exactly. The sources emphasized that failing to report crypto income or gains could lead to serious penalties.
And was that just a U.S. thing?
No, not at all. The material shows similar tax policies emerging in countries like Australia, Japan, and the UK. It became a clear trend. Governments needed ways to track and tax these assets moving through the digital economy.
Okay, now, let's zoom out and look at the global picture today, because your sources really underscore how incredibly varied the approaches are. It's anything but harmonized right now, is it?
Not even close. You see a whole spectrum, from countries trying to actively foster the technology to others imposing significant restrictions or even, outright bans.
Let's start with the more restrictive end then. China is a country that really stands out in the sources for its significant impact. They had restrictions on ICOs and exchanges pretty early on, back in 2017.
Right. And then they really ramped up the crackdown in 2021. One source indicates this culminated in a full ban on trading and mining that reached peak intensity on May 31st, 2025.
Wait, 2025? That's quite specific and still in the future. Are other sources saying the ban happened earlier?
Yeah, the date is unusual and worth noting is coming from one specific source. Other sources in the material focus on the major crackdown measures announced in September 2021, which effectively banned all crypto transactions domestically and accelerated the exodus of miners. So the timeline details vary slightly, but the overall trajectory toward a full ban is consistent.
Okay, so a progressive tightening culminating in a near total ban, maybe hitting full force by that 2025 date, according to one perspective, or effectively in place since late 2021, according to others. What were the reasons given?
The reasons cited in the sources are pretty varied. Concerns about the huge energy consumption of mining. One article noted China's dominance in the global hash rate, like the computing power, dropping from maybe 75% down to 46% because of this crackdown.
Wow, that's a huge shift.
It is. They also cited risks to financial stability, the need to curb illegal activities like money laundering and fraud, and importantly, a desire to clear the way for their own central bank digital currency, the digital yuan.
So control and promoting their own alternative. And the source mentioning that May 31st, 2025 date, did it detail the market impact?
It did. It noted the immediate market impact.
Yeah.
The crypto market plummeting over 10% right after the announcement tied to that future date. Bitcoin specifically dropped from over $111,000. Seems like a very high price point to mention, maybe a typo in the source or referring to a future prediction. Anyway, dropping to below $104,000. Other alts saw losses exceeding 12%.
Hmm. Those price points sound unusual for Bitcoin historically. Maybe they meant thousands, like 11K and $10, or perhaps the source had a typo. But the percentage drops seem plausible after major negative news.
Yeah, the specific dollar figures seem questionable, potentially data error in that source, but the scale of the drop, over 10% market-wide, wiping out hundreds of billions in value and triggering about $750 million in liquidations that kind of impact tracks with major regulatory shocks.
Okay, so the key takeaway is a massive market reaction, regardless of the exact price figure cited.
Exactly. That level of detail, even with potentially odd numbers, really underscores the forcefulness of China's regulatory moves and the shockwave it sent through the market. And the material shows it directly led to companies moving offshore, Huobi closing mainland accounts, Bitmain ceasing sales to mainland miners, Sparkpool stopping services to Chinese users. A real exodus.
Beyond China, the sources mention India as another large economy with a, let's say, fluctuating approach.
Yeah, fluctuating is a good word. There was a central bank ban in 2018, which the Supreme Court actually reversed in 2020, but there's still ongoing uncertainty, including active consideration of a ban on private crypto while they explore their own central bank digital currency, their CBDC.
So kind of keeping their options open, but leaning restrictive, perhaps. Any others mentioned with bans?
And you see other countries noted with bans or severe restrictions. Places like Egypt, Indonesia, and Nepal were mentioned.
Okay. Now, on the flip side, the sources highlight countries taking more progressive or embracing approaches. We already touched on Japan's framework.
Right, which the material describes as recognizing Bitcoin as property and establishing those clear licensing requirements for exchanges way back in 2017.
And having that clear structure and a single agency overseeing it, the FSA, as the sources note, really helped position Japan as a leader in providing regulatory certainty early on. It probably fostered some growth there.
Definitely seems that way. Switzerland is another prime example highlighted, known for fostering its crypto valley.
Right, in Zug.
Exactly. This was achieved through supportive regulations and clear legal frameworks, especially for ICOs and crypto businesses, helping it become a really significant hub.
Then you have these fascinating dynamics in emerging markets, which offer totally different perspective, don't they? El Salvador, for instance.
Yeah, becoming the first country to adopt Bitcoin as actual legal tender in 2021. Big news.
The aims there, according to the sources, were huge. Boosting financial inclusion for the, unbanked population, attracting investment, and lowering the cost of remittances for people sending money home. Crucial for many families.
Definitely. But the sources also made sure to mention the significant challenges, criticism from the IMF, for one, and the inherent volatility risks of tying your national currency, even partially, to Bitcoin's wild price swings.
Yeah, that's a big gamble.
And you see similar exploration of crypto-friendly regulations in other Latin American countries like Brazil and Argentina, often driven by really pressing needs related to high inflation or trying to facilitate financial inclusion, where traditional banking maybe falls short.
And what about Africa? The sources mentioned rapid adoption there, too.
Yeah, rapid adoption happening in parts of Africa like Nigeria and Kenya, often because high traditional banking costs and inefficiencies make crypto an attractive alternative for payments and remittances. It just works better for some people day to day.
So necessity driving innovation there.
Exactly. And regulators there are grappling with that classic balancing act. How do you protect users from scams and volatility while still allowing for this potentially beneficial innovation?
Okay, let's maybe deep dive into a couple of specific areas that your sources suggest are major focuses for regulators right now. Stablecoins and decentralized finance, or DeFi.
Yeah, good idea. Stablecoins have just exploded in popularity. You'd think of names like Tether, USDC. The sources explain their main purpose is to minimize that crazy crypto volatility by being pegged, usually one-to-one, to a traditional currency, like the US dollar.
So they're meant to be, well, stable, but their rapid growth has brought equally rapid regulatory concerns, hasn't it?
Oh, absolutely. The sources discuss worries about their potential impact on monetary policy if they become too widely used, kind of like a parallel currency system. Plus, risks to financial stability if a major stablecoin were to collapse.
Like if everyone tried to cash out at once.
Exactly, a run.
Yeah.
And a fundamental question about whether the reserves supposedly backing these stablecoins, the dollars or bonds or whatever, are actually sufficient and transparent. Are they really holding what they say they're holding?
That's a critical point, isn't it? If a major stablecoin isn't fully backed and faces a run, could that spill over and cause instability in traditional finance? That seems to be the big fear.
That's the systemic risk concern, yeah. The sources point to potential future regulations that could treat stablecoin issuers much more like banks requiring clearer reserve disclosures, regular audits, and stricter AML KYC rules, basically bringing them into the traditional financial regulatory fold.
Okay, makes sense. Then there's DeFi, decentralized finance. This is where lending, borrowing, trading, all that stuff happens directly on blockchain platforms using smart contracts without the usual banks or brokers as intermediaries, right?
That's the core idea.
Yeah.
What's fascinating here are the significant challenges DeFi poses for regulators, because it's often pseudonymous. You don't necessarily know who is on the other side of a transaction, and it often has no central company or person in charge.
So who do you regulate?
Exactly. Applying existing AML KYC rules is incredibly difficult. There's no single point of control, and the complexity and a rapid evolution of these smart contracts add another layer of difficulty.
The sources highlight the risks here too, I assume. Things like bugs or hacks.
Definitely.
Yeah.
Vulnerabilities in the smart contract code, potential for scams, rug pulls, things like that, and just user error leading to irreversible losses because there's no central body to appeal to.
Right.
Regulators are really grappling with how to supervise something so inherently distributed and automated.
So what are the potential approaches? What did the sources say?
Well, potential regulatory approaches mentioned include pushing for greater transparency in DeFi protocols, maybe requiring security audits of smart contracts before they launch, and trying to interpret how existing financial regulations might apply to certain DeFi activities, like maybe treating some platforms as unregistered exchanges or lending operations.
Still feels like trying to fit that square peg in a round hole, though.
It's a major test for traditional regulatory models, which were really designed for centralized entities. DeFi is a whole different beast.
Okay, so looking ahead then, the sources identify some major frameworks and trends that will likely shape the future of crypto regulation. What stood out?
One landmark development highlighted is the EU's MiCA framework, that's markets in crypto assets. This is a really comprehensive piece of regulation designed to create clear rules across all EU member states.
What are the goals there?
The aims are pretty clear: consumer protection, ensuring financial stability, but also trying to foster responsible innovation by providing legal certainty.
And when does that kick in?
It's expected to be fully implemented around 2024, according to the sources. And it aims to standardize rules for crypto service providers, stablecoins, even utility tokens. Should provide a lot more clarity for businesses operating in Europe.
What about the U.S.? Still a bit fragmented.
Yeah, developments continue, particularly with the SEC's ongoing focus on classifying many cryptocurrencies as securities. That high-profile lawsuit against Ripple, noted in the sources, is a prime example of their determination to apply existing securities law. Still playing out.
Though there are also signs of potential evolution, right? Like the approval of the first Bitcoin futures ETF in 2021, mentioned in one article, that allows easier access for certain types of investors through regulated products.
Right, a step towards integrating crypto into more traditional investment channels, at least indirectly through futures contracts.
Okay. Another major trend globally, mentioned quite a bit, is the exploration and development of central bank digital currencies, or CBDCs.
Yeah, these are essentially regulated, government-backed versions of digital currency. We're seeing pilots like China's digital yuan, which is quite advanced, research from the U.S. Federal Reserve and the European Central Bank, and countries like Sweden actively developing an e-krona. Lots of activity.
What's the potential impact there? Will they replace existing crypto?
The sources discuss that. They could potentially reduce demand for private stablecoins by offering a safer, regulated digital alternative for payments. But it's also likely they'll coexist with other forms of crypto.
How so?
Perhaps with CBDCs used for everyday transactions, things that need stability and government backing, while other cryptocurrencies continue to be used for investment, speculation, DeFi applications, or specific blockchain functions. Different tools for different jobs, maybe?
Right. Now, what's clear from surveying the global landscape in these sources is that problem of fragmented regulations we discussed earlier. It can lead to regulatory arbitrage, right? Businesses just moving to wherever the rules are lightest.
Exactly. Which raises an important question.
Yeah.
Is that sustainable in the long run? The sources point to a growing need for international collaboration and global standards.
Is anyone actually working on that?
Yeah, they mentioned efforts by groups like the Financial Action Task Force, FATF, which works on global anti-money laundering rules. They're actively developing standards for crypto. The goal is to reduce those loopholes and ensure some level of consistency across borders, make it harder to hide illicit activity.
Okay, one last area, the environment. That's become a huge topic around crypto, hasn't it?
Definitely. The sources touch on environmental regulation, which is a growing concern, particularly around the energy consumption of proof-of-work cryptocurrencies like Bitcoin mining. It just uses a lot of electricity.
So what are regulators thinking there?
Well, regulators and policymakers are beginning to consider this more seriously. Potential approaches could include incentives for using renewable energy in mining operations, or perhaps regulations that support the shift to more energy-efficient mechanisms like proof of stake.
Like what Ethereum did.
Exactly. Ethereum's recent transition to proof of stake, the merge, is highlighted in the sources as a really significant example of this shift towards greater efficiency. Shows it can be done.
Wow, okay. We've covered a lot of ground in this deep dive into your sources, from Bitcoin being dubbed a legal platypus in the US to massive regulatory shifts and bans in places like China and the development of comprehensive frameworks like MiCA in Europe.
It's abundantly clear, isn't it? The world of crypto regulation is just incredibly dynamic and, frankly, really complex. It's this constant negotiation between wanting to foster innovation, but also needing to protect consumers and investors from risks, maintain financial stability.
And governments wanting to ensure compliance and maybe maintain control over monetary systems.
Yeah.
Whether it's the IRS seeing property, the CFTC seeing a commodity, or entire countries imposing bans or building detailed legal structures, pretty much from the ground up, the attempts to fit this inherently borderless and decentralized technology into existing or new regulatory boxes are ongoing and just vastly different across the globe.
And as new challenges like stablecoins and DeFi keep emerging, alongside government-backed CBDCs, the story is clearly far from over. This isn't settling down anytime soon. Not at all. This deep dive into the sources really highlights the sheer speed and complexity of this evolving landscape and how regulators worldwide are essentially trying to keep pace with technology that moves much, much faster than legislation typically does.
So here's something for you to mull over as you go about your day. Given the truly borderless nature of cryptocurrencies and these wildly different regulatory paths countries are currently taking, how likely is it that we'll eventually see truly unified global standards emerge? And maybe more importantly, what does the future of digital finance look like if we don't get that unification? It's a question that's definitely going to shape the next decade, I think.